Welcome to Wisdom Owl. The company we are going to talk about, which is undervalued and is worth looking at, is Monday.com. Now, Monday.com is a $9 billion company, and in future, it can see some strong revenue growth. And with respect to this future outlook, the company seems to be undervalued. And in the next 5 minutes, we're going to talk about how undervalued it is and why it could be a good opportunity. So Monday.com, to give you some context, the name of their SaaS product is Work OS, and it helps businesses develop custom application development and workflow management. This SaaS subscription had around $300 million in revenue in Q2 2025. They are seeing amazing growth year over year, around 26%. Their primary revenue is actually coming from this Work OS subscriptions. They also have developed recently some high growth segments, which is coming from their AI features like Monday Magic, Vibe, and Sidekick. These features are boosting productivity and accelerating user acquisition. If we talk briefly about some of the pros and cons of investing in Monday.com, there is a growth driver. They, because of these AI-powered features, is helping new customers with advanced automation. Similarly, with all of these features and already have so many clients, they have competitive advantage, which can help them to grow their revenue from existing customers. They are showing a lot of financial strength. Their current revenue and even revenue of last year's has grown dramatically. And we look into last year's 5 years revenue as well. But this recently reported revenue showed 26.6% growth. They are also doing some external partnerships. So that way the business do have some pros. In terms of the investment risk, there is market and competitive risk related to what if there is increased competition and other larger firms start to get into this work management space. Other than this, there are some SaaS related operational and industry risks. And there are other players like Asana, which are also a high overlap with their product. So there can be some more questions which investors should look at. If you want to look into what are their key differentiators from the Asana product, you can log on to app.wisdomowl.ai and read this complete analysis free of cost. Now, coming back to our main objective, let's understand what has been happening in the business in last 5 years. The most important thing is, if you see this dark brown earnings, which means the historic EPS, right? And they became profitable or positive earnings in the last financial year. The stock price rallied a lot, right? From less than $100 to more than $300. And now it has again dropped to around $170. But analysts are still estimating that there can be a lot of growth in this business. Let's understand why this could be, or what has happened in the business in last 5 years and what could be our investment thesis. The investment thesis here is that it's a high growth SaaS business with rapidly increasing revenue, but in profitability, they'd see strong cash flow generation. So they can become more and more profitable. It can be a good investment opportunity for growth oriented investors. Now let's understand what are their key financial metrics and what are they looking like. If we look at the key observations, we can see that the revenue growth is exceptional. If we look at the revenue per share of Monday.com in last 5 years, it has grown from $4 to around $20, right? 5x in 5 years, amazing growth. Another point to note is that the profitability metrics have shown dramatic improvement. For example, if we look at their net profit margins have gone from negative 94 to 5%. So they are turning from very negative to positive, but still the net margins are not the highest and they're still spending money on their growth. If you see the gross margins, amazing gross margins as expected from high quality SaaS businesses, right? Their gross margins are around 89%, which is a big green. Their operating profit margins are still negative and they are spending a lot of money on growth. Now, the free cash flow generation has also turned strongly positive. Their free cash flow has gone from 0.06 to 6.13, right? Amazing growth in free cash flow, and this can translate to their net profits as well. The valuation multiples remain high. They are trading at 30 to their free cash flow, but the company is showing strong fundamentals. Their balance sheet is completely healthy with ample liquidity and minimal debt, as can be seen in their quick ratio and debt to equity ratio. The question we are discussing, okay, they have shown some considerable growth, then what would the future look like? Now, if we look at what Wall Street analysts are estimating that their revenue can grow to around 2.7 billion in next 5 years. But even if say their revenue can grow to say just 2.4 billion, being conservative, right? They can achieve this 2.4 billion revenue in next 5 years, even if they end up growing at around 18%. Now the question is, can they grow at 18% for next 5 years? The answer seems plausible. If you factor in all the growth factors, which can be enterprise customer expansion from their existing customers, they have a high gross margin of 89%, they have a SaaS revenue scalability model, all of this can contribute very positively to their future growth. Similarly, there are some negatives like pricing pressure, customer acquisition cost inflation, platform commoditization. Even considering those negative factors, 18% seems plausible. Okay, let's look at what the valuation look like for this 18% growth. The valuation number, the recommended buy price based on the forward strong revenue of 18%, if the company can grow their revenue at 18% for next 10 years, even $337 of price can justify that, right? Because this strong revenue growth will further translate into earnings, and that earning can take the stock price much higher. Since earnings are very nascent, it's not correct to just look at earnings related metrics to value the company. They have just become positive, so earnings multiple seems very high. Instead of looking at earnings, you should look at the strong revenue or the revenue multiples. In this plot, what is shown is price to sales multiple or price to revenue ratio. Their price to revenue ratio is currently at 8.64, which is almost the lowest it has ever been. Also, if this orange line, which is the nearest correction of 2022, the company was trading even during the recent correction at similar price to sales ratio. So from that perspective, the valuation multiple of price to sales is very low. If the company can grow at 18%, then current valuations is very lucrative, and it might be a good time to take a starting position and then further track the revenue growth going forward. Hope this helps. If you have any questions, please feel free to comment. If you want to read about any of the other undervalued businesses, go to app.wisdomowl.ai. Thank you.